Oil routes are snarled. Inflation risk is creeping back. Yet equities keep printing new highs and volatility is still subdued. This tension between an AI-powered equity boom and an energy-driven inflation shock is front and center for allocators. Welcome to vTalkInsight, Allocators Lens Daily for May 27, 2026. In equities, the dominant story is that AI-driven earnings strength is overpowering almost every macro concern, at least for now. The S&P 500 is pressing fresh highs after weeks of gains, helped by declining long-term yields and powerful performance in technology, even as headlines from the Strait of Hormuz would normally argue for a more cautious stance. Semiconductors are the epicenter of this move, accounting for well over half of the year-to-date rally, which leaves index leadership extremely narrow. Micron surged after a major target upgrade, a swing in its gross margins from deeply negative to above 80%, and broader earnings upgrades across the chip complex underscore how tight supply and AI infrastructure demand are supporting profits. Under the surface, earnings are genuinely impressive. Recent S&P profit growth has been around the mid-20s, with consensus now expecting high teens growth for the coming quarters and estimate for the year lifted sharply in just a few weeks. That fundamental backdrop helps justify high multiples. Yet the equity risk premium has shrunk to levels last seen around the dot-com era, meaning equities offer far less compensation over bonds than usual. Leadership is also uneven. Hardware and hyperscaler-linked names look frothy, while software multiples have compressed sharply as investors wait for proof that AI can re-accelerate revenue, and AI-adjacent stocks face heavy short interest and high borrow costs. At the same time, implied equity and foreign exchange volatility have drifted back toward pre-conflict norms, making portfolio hedges against a reversal in the AI trade or an escalation in the Gulf relatively inexpensive. Turning to rates, the key question is how the renewed energy shock interacts with already sticky inflation. Central banks are becoming much more attentive to second-round effect from higher oil, with expectations that headline inflation could hover near 4% this year, even if geopolitics ease, and that core pressures may stay elevated as food and retail costs filter through. The Federal Reserve is widely expected to push its inflation projections higher in the next upplot, reinforcing a higher for longer narrative and keeping the door open to renewed hikes if core measures stall around 3%. In Europe, markets still price additional European Central Bank tightening despite weak activity data, while long-end global yields remain under pressure from fiscal deficits and structurally higher real rates linked to AI and infrastructure investment. This backdrop leaves the curve caught between medium-term upward pressure on yields and bouts of tactical buying when levels look stretched. Recent demand for long-duration treasuries as 30-year yields approach the low 5% area and positioning for flattening show that some allocators see current-term premia as rich, even as front-end yields may still be underpricing the risk that persistent energy inflation forces policy to stay restrictive for longer. In credit, the story is one of healthy carry but increasingly uneven fundamentals. With government yields elevated and spreads still relatively tight, particularly in higher quality corporate bonds, many allocators are emphasizing income rather than expecting big gains from spread tightening or rate rallies, especially as rising risk-free rates have dominated total returns. At the same time, corporate default rates in the United States have climbed into the mid-single digits and are still rising, pointing to more restructurings ahead. Tech and AI infrastructure are adding another layer, as hyperscalers tap bond markets heavily to fund capex, with hedge funds comfortable selling protection on these highly rated borrowers even as spreads in the sector are expected to drift wider with ongoing issuance. Private credit continues to attract institutional capital, but deployment is shifting toward distressed, special situations, and opportunistic lending rather than traditional senior direct loans. Spreads and covenants still offer an illiquidity premium, yet relative value versus liquid credit is increasingly debated, and some see opportunistic credit as a more flexible way to capture equity like upside with downside protection while leverage capital structures reprice. Foreign exchange markets are reflecting the same energy and inflation fractures. Emerging market currencies in energy-resilient economies, such as Brazil and Mexico, have generally outperformed, while import-dependent regions in parts of Latin America and emerging Europe have seen meaningful repricing as higher fuel and food costs bite into external balances. A potential geopolitical resolution that brings temporary waivers for Iranian oil exports and lower crude prices could weaken the dollar, which in turn might act as a catalyst for renewed inflows into emerging market local currency debt and equities. There is also a growing narrative that some emerging markets, especially those plugged into the semiconductor and AI capex cycle, are becoming more driven by secular technology demand than by traditional U.S. rate shocks. The other standout is the yen, where persistent weakness is anchored in wide policy divergence. With the Bank of Japan keeping rates low despite above-target inflation, short yen positions continue to benefit from negative carry, and any sustained move of Japanese government bond yields above 3% on the 10-year could trigger repatriation flows that spill over into European fixed income and currency markets. Commodities, and oil in particular, remain the macro fulcrum. Escalating tensions in the Strait of Hormuz, including U.S. and Israeli strikes on Iranian vessels and reports of mines and shipping blockages, have pushed Brent prices higher again after a sharp pullback, with thousands of vessels delayed and renewed concern about fuel, commodity, and food price spikes. So far, oil markets still look somewhat complacent, with prices rebounding but not fully pricing a prolonged closure or major escalation, even though many scenarios would keep headline inflation elevated and gradually erode consumer discretionary spending as gasoline stays above painful thresholds. Central banks are increasingly focused on this stagflation risk, weighing persistent supply shocks against already fragile underlying growth and the limits of policy effectiveness. Gold is sending a different message. Its recent softness, despite geopolitical stress, reflects firm real yields and possible central bank selling, meaning it has not behaved as a classic hedge. History and current commentary suggest that a clear catalyst for a renewed gold rally would be a shift toward rate cuts and negative real yields, while in the meantime some allocators are leaning more on broader real assets, including energy and infrastructure, as inflation protection. Across assets, the picture is one of powerful AI-led earnings and resilient consumer spending running headlong into a stubborn energy shock and higher for longer interest rate regime. Equities are enjoying record levels with narrow leadership and a very slim risk premium over bonds. Rates are wrestling with sticky inflation and fiscal overhangs. Credit is offering carry, but quietly absorbing rising defaults and heavy issuance. Currencies are splitting along energy and policy lines, and commodities, led by oil, remain the key swing factor for both inflation and growth. For allocators, the immediate watch points are the trajectory of U.S. and Iran negotiations, the path of oil prices, upcoming central bank communications on inflation, and the next wave of AI and software earnings, all against a backdrop of still modest implied volatility that keeps portfolio protection relatively cheap. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.